I think that it's not telling you much about the strength of the U.S. economy. It's really telling you if there's problems, that it relates more to what the U.S. dollar's been doing to the large cap companies that are very export oriented. I think actually the U.S. economy, I mean, first quarter we know was soft for a bunch of transitory reasons, as was the case last year. But the earnings right now, really, you know, when you take a look at the domestic sectors of the economy, you strip out the impact of oil, the earnings really aren't that bad at all. We still haven't seen the full impact of what the currency has done. I mean, it was up 20% trade weighted in a short period of time, and the impact of the dollar on earnings is a lagged impact. So this is going to continue for the next few quarters. I think one of the reasons why you might want to look through it is that, you know, the U.S. dollar is not going to be a hockey stick going straight up, you know, to perpetuity. At some point, it is going to level off. So this is more temporary, in my opinion, than permanent.
I would say for the U.S., the companies that are in emerging markets that are global in scope, yes, those might be interesting if the price is right, because you must remember you've had a tremendous run-up in prices. But right now, we're seeing emerging markets outperforming the U.S. and the world. Since the beginning of this year, we've seen this outperformance. So I think now is the time to shift out of the U.S. into other markets.
To be fair, this has been a positive year for equities almost across the board. The S&P is the laggard after several good years of outperformance. But the fact is, in our view, the bull market continues in the U.S., and it's a good place to put your money. You've got this great combination of low oil, low interest rates, and excessive pessimism about earnings that we're going to climb through. We think there's a potential for a catch-up trade. There's a lot of risk events out there, whether it's Greece or, you know, other ongoing geopolitical concerns. But we do think at this point it could be a time where the U.S. catches up.
You know, the valuation is such that these German bonds, 10 years, 9 years, basically yield nothing, and that there's a minus 20 basis point barrier through which Draghi will not continue to buy. And so that simply means that a 9 or a 10-year bond has an upside of 1.5 points if you buy it, as it moves to minus 20 basis points. I know it sounds complicated, but it has a downside perhaps of 10 or 15 points, and it's just a question of when. It's just a question of when. It's certainly a trade that doesn't cost you anything in the short term because it doesn't yield anything, and it has an ultimate potential of 10 or 15% over a 1 or 2 year period of time.